Welcome to The Explainer. Today we are jumping right into a question that trips up a lot of investors. You want to track the market, but what's the right tool for the job? An index mutual fund or an ETF? You look at them and think, hey, they do the same thing, right? Well, yes and no. They might have the same destination, but the way they get there and who should be in the driver's seat is totally different. By the end of this, you'll know exactly which one is for you. Okay, let's break it all down. To really get to the bottom of this, we've got to understand how these things actually tick, and, maybe more importantly, who they're really built for. So here's how we're going to tackle it. First, we'll introduce our two main players. Then, we'll do a little soul-searching to figure out what kind of investor you are. After that, we'll throw them in the ring for a head-to-head comparison on the stuff that really counts. And by the end, making your decision should be a piece of cake. All right, first things first, let's properly meet our two main vehicles for just riding the market waves. Okay, so here's the most important thing to remember right out of the gate. Both of these things, at their core, have the exact same goal. We're not trying to be the next Wall Street genius here. The whole point is to simply match the market's return, what the pros call getting the beta. Simple as that. So on one side, you've got the old school champ, the OG of passive investing, the index mutual fund. And on the other, you've got the newer, faster kid on the block, the ETF. And that one little detail, that it trades like a stock, oh man, that changes everything, as you're about to see. All right, before we dive into the nitty-gritty, let's just pause for a second. Because believe it or not, the right choice here has less to do with the funds themselves and a lot more to do with, well, with you. So take a look. Which one of these sounds more like you? Are you the set it and forget it type? The person who wants to make a plan, automate it, and just let it grow for the next 20 years without touching it? Or are you more of the hands-on, tactical investor, someone who wants total control, the ability to zig when the market zags? Be honest with yourself, because your answer here is going to be your compass. Okay, you've got your investor type in mind? Perfect. Now for the main event. Let's put these two head-to-head and see how they stack up where it really, really matters. This right here, this is probably the single biggest difference between them. A mutual fund only trades once per day. After the market closes, they tally everything up and give everyone the same price. That's it. But an ETF, it's like a stock. You can buy it at 9:31 in the morning, sell it at 2:45 in the afternoon. Prices are changing second by second. It is a totally different ballgame. And what's so cool about that is how this one feature completely unlocks a different way of investing. If you're that tactical investor, you can react to a news story instantly. You can even bet against the market by short selling an ETF. It gives you this incredible speed and precision that you just don't get with a mutual fund. So what does it take to get started? Well, that's different too. A lot of mutual funds, they want you to show up with a decent chunk of cash right at the beginning, maybe a few $1,000s, and they really aren't big fans of people jumping in and out. ETFs, though, you can literally buy one single share. The only catch is if you trade all the time, those little trading commissions can start to add up. All right, now for what might be the most shocking difference of them all. Get this. With one of these funds, the actions of other investors, total strangers, can actually land you with a tax bill. Sounds crazy, right? But it's true. And here's how that phantom tax event happens. Picture this. The market takes a dive, and a bunch of people get scared and sell their mutual fund shares all at once. To give them their cash back, the fund manager has to sell stocks from the fund's portfolio. Now, if those stocks have gone up in value, selling creates a capital gain. And here's the kicker. That gain gets passed on to every single person still holding the fund, including you, even though you didn't sell a thing. Wild. ETFs have this really clever way of avoiding that whole mess. See, when you sell your ETF share, you're not selling it back to the fund company. You're just selling it to another investor on the stock market, like passing a baton. The fund manager rarely has to sell underlying stocks to cash people out. It's a structural difference that, generally speaking, makes ETFs way more tax efficient. And last but not least, let's talk dividends. This part really just perfectly sums up the whole difference between them. The mutual fund is all about automation. It'll take your dividends and automatically reinvest them for you. That's the set it and forget it dream for compounding growth. The ETF, on the other hand, is all about control. It drops the cash from the dividends right into your brokerage account and says, okay, it's your money. What do you want to do with it? Okay, so we've put them through their paces. We've compared them on trading, taxes, and everything in between. So let's bring it all together and make the final call. This chart really lays it all out, doesn't it?
If you're that set it and forget it investor and you value simplicity and automation above all else, the classic index mutual fund was practically built for you. But if you're the hands-on, tactical type who craves that stock-like flexibility, that control, and better tax efficiency, then yeah, the ETF is going to be your go-to.
But in the end, as our source material wisely points out, there's no magic one-size-fits-all answer here. The best choice really comes down to a mix of things: your own goals, your personality, and your overall financial situation. So the real question isn't which one is better. The question is for you. Now that you understand the difference, the why behind each tool and how they fit different styles, you're in a much, much better position to choose the right one to build your financial future.